You know what nobody's talking about right now? The fact that we're watching one of the most predictable market setups in precious metals history unfold in real time, and most people are going to miss it completely. I'm talking about silver. And before you roll your eyes thinking this is just another metals pitch, let me show you something that should make your hair stand on your neck. Right now, as I'm recording this, silver is trading around $31 per ounce. That sounds expensive if you remember when it was $15 or $18. But here's what's actually happening behind the scenes that changes everything. The global supply deficit for silver just hit 215 million ounces. Let me put that in perspective. That's the largest supply shortage in recorded history for this metal. We're not talking about a little supply crunch. We're talking about industrial demand consuming more silver than the entire planet can mine. And it's accelerating. But here's where it gets interesting. While this deficit is exploding, something else is happening that almost nobody is connecting. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting at around 88-1 right now. Historically, that ratio averages about 60-1, and in times of monetary crisis, it's collapsed to 15-1. Think about what that means. If silver just returns to its historical average ratio with gold at current gold prices, we're looking at silver north of $45 per ounce. That's a 45% move from here. But if we see anything resembling the crisis ratios from 1980 or even 2011, you're looking at triple-digit silver. Now, I know what you're thinking. You've heard this story before. Silver's always about to explode, right? Except this time, there's something fundamentally different happening in the physical market that's never occurred before in modern history. Let me walk you through it. The United States Geological Survey just released data showing that at current mining rates, we have about 20 years of economically viable silver reserves left in the ground. 20 years. But here's the kicker. That calculation was done assuming current demand levels. What they didn't account for is that silver demand is about to go parabolic, and I can prove it. Electric vehicles. Every single EV requires between 25 to 50 grams of silver just for the electrical contacts and conductivity applications. Sounds small, right? Except the International Energy Agency is projecting 145 million EVs on the road by 2030. We're at about 40 million today. That's 105 million new EVs in the next 5 years. At 35 grams average per vehicle, that's 3,675 metric tons of new silver demand just from EVs per year. And that's conservative. But EVs are just the beginning. Solar panels. Each solar panel installation requires about 20 grams of silver. The global solar capacity is expected to triple by 2030 as countries scramble to meet climate commitments. That's another 4,000 metric tons of annual demand. Then you've got 5G infrastructure, which requires 30% more silver per cell tower than 4G. Medical applications, where silver's antimicrobial properties make it irreplaceable. Water purification systems. The list goes on. Here's what nobody's putting together. All of this new industrial demand is hitting at the exact same time that above-ground silver inventories are at multi-decade lows. The COMEX, which is the major futures exchange for silver in the United States, has seen its registered silver inventory, that's the silver actually available for delivery, drop by 68% since 2021. We're talking about falling from 150 million ounces to under 48 million ounces today. Let me tell you a story that illustrates what's really happening. In March of 2023, a major industrial manufacturer, I can't name them for legal reasons, but they're a Fortune 100 company, went to secure their annual silver supply contract. They'd been buying the same amount for 15 years, roughly 2 million ounces per year. Their supplier, one of the largest precious metals dealers in North America, told them they could only guarantee 60% of their order, and the price would be $4.50 per ounce over spot. That's a massive premium. This company had never paid more than $1.20 over spot in their entire history. You know what they did? They paid it. Because they had no choice. Their entire production line depends on silver, and there was no alternative supplier who could deliver the full amount. That's not a supply inconvenience. That's the beginning of a supply crisis. And here's where it gets even more interesting. While industrial users are scrambling for physical metal, something bizarre is happening in the paper markets. The commercial short position on the COMEX, that's the big banks and institutions betting against silver, just hit levels we haven't seen since right before the 2011 silver spike. Back then, silver went from $18 to $49, in less than 4 months. The setup is almost identical. But there's a twist this time. In 2011, when silver spiked, it was primarily driven by investment demand. People were scared about the financial crisis aftermath and piled into precious metals. The industrial demand was steady but not explosive. This time, you've got both. You've got investment demand coming back as inflation fears resurface and people lose faith in currencies. And you've got this unprecedented industrial demand surge that's not going away. It's structural, not cyclical. Let me paint you a picture of what's happening in China right now, because this is the part that should terrify anyone short silver. China is the world's largest silver consumer, using about 6,000 metric tons per year. That's roughly 193 million ounces. They're also the world's largest solar panel manufacturer, largest EV market, and they're building out 5G infrastructure faster than any country in history. Their silver demand is projected to increase by 40% over the next 3 years. But here's the problem. China only produces about 3,600 metric tons of silver domestically. They're a massive net importer. And right now, China is in the middle of a strategic resource accumulation phase. They're not just buying silver for immediate industrial use, they're stockpiling it. We know this because Chinese silver imports in the first half of 2024 were up 47% year over year, but their industrial production only increased by 12%. Where's the rest going? Strategic reserves. This is the same playbook they ran with rare earth elements, with copper, with lithium. They identify a critical resource. They accumulate it quietly while prices are reasonable, and then they control the market. And silver is absolutely a critical resource for the technology transition they're betting their entire economic future on. Now let's talk about what's happening with the US dollar for a minute, because this is the macro backdrop that's going to accelerate everything I just described. The dollar index has been weakening, and more importantly, central banks around the world are diversifying away from dollar reserves at the fastest pace since the 1970s. We just saw the BRICS nations, that's Brazil, Russia, India, China, and South Africa, announce they're developing a commodity-backed trade currency. Guess what commodities they're talking about? Gold and silver. When countries start backing currencies with hard assets again, the demand dynamics for those assets change completely. It's not just industrial users and investors competing for supply anymore, it's sovereign nations. And sovereign nations don't care about price. They care about securing supply. Period. Let me give you a historical parallel that's almost eerie in its similarity. In 1971, when Nixon closed the gold window and ended dollar convertibility to gold, silver was trading around $1.50 per ounce. Over the next 9 years, as inflation exploded and people lost faith in paper currencies, silver went to $50. That's a 33x return. But here's what most people forget. The real move didn't happen gradually. Silver sat between $4 and $6 for years. Then, in 1979, it went from $6 to $50 in just 14 months. The setup today is remarkably similar, except the supply situation is far more dire. In 1979, there was plenty of silver in the ground. Mining could scale up to meet demand. Today, we're already mining at maximum capacity, and the easy deposits are gone. The silver that's left requires more energy, more capital, and more time to extract. You can't just flip a switch and increase supply. Speaking of supply, let me tell you about what's happening in Peru and Mexico, which together account for about 40% of global silver mine production. Both countries are facing significant political and operational challenges. Peru just implemented new mining regulations that are expected to reduce output by 8% over the next 2 years. Mexico is dealing with cartel violence that's disrupting operations in key mining regions. These aren't temporary issues. They're structural problems that are going to constrain supply for years. Meanwhile, the cost of silver production has been rising steadily. The all-in sustaining cost for primary silver miners is now around $22 per ounce. That's up from $14 just 3 years ago. Energy costs, labor costs, equipment costs, environmental compliance costs, they're all going up. And here's the thing about mining economics. When the price of a commodity gets too close to the cost of production, mines shut down. We're already seeing this with some of the marginal producers. They're not profitable at current prices, so they're reducing output or closing entirely. This creates a vicious cycle. Lower supply pushes prices higher, which eventually brings marginal producers back online. But there's a lag time. It takes years to restart a mine or bring a new project into production. During that lag, the supply deficit gets worse, and prices can spike dramatically. Now, here's something most people don't understand about silver that makes it uniquely explosive compared to other commodities. Silver is primarily a byproduct of other mining operations. About 70% of silver production comes from mines that are primarily digging for copper, zinc, lead, or gold. Silver is just a secondary product. What this means is that silver supply is relatively inelastic. Even if silver prices double, you're not going to see a massive increase in silver mining because those operations are making their money from the primary metal. Silver is just a bonus. This is completely different from something like copper or iron ore, where high prices immediately incentivize more production. With silver, the supply response to higher prices is muted and slow. But the demand response is immediate and aggressive. As soon as silver starts moving, investment demand floods in. Industrial users panic buy to secure supply, and you get a feedback loop that can send prices vertical in a very short time. Let me tell you about what happened in the silver market in early 2021, because it's a preview of what's coming. Except next time it's going to be much bigger. In January 2021, a group of retail investors on Reddit decided to squeeze silver. They started buying physical silver and silver ETFs aggressively. Within 2 weeks, premiums on physical silver coins and bars went from $2 over spot to $8 over spot. Dealers ran out of inventory. Mints couldn't keep up with demand. The US Mint had to ration silver eagles. And here's the crazy part. That squeeze was driven by maybe a few $1 billion of retail buying. It wasn't institutions, it wasn't industrial users. It was just regular people buying coins and small bars. And it nearly broke the physical market. Now imagine what happens when institutional money starts flowing in. When pension funds and sovereign wealth funds decide they need silver exposure. When industrial users start panic buying because they can't secure supply through normal channels. The silver market is tiny compared to other asset classes. The entire above-ground silver inventory, everything that's been mined throughout human history and still exists in some form, is worth maybe $1.4 trillion at current prices. That sounds like a lot until you realize that's less than 1% of global financial assets. Apple's market cap alone is more than twice the value of all the silver in the world. If even a small percentage of global capital decides it needs silver exposure, there's simply not enough metal to go around at current prices. Quick aside here, because this is relevant if you're thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers how to get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're concerned about currency debasement and want some hard asset protection in your portfolio. Anyway, back to what's happening in the silver market right now. One of the most telling indicators is what's happening with silver ETFs. The largest silver ETF, SLV, has seen consistent inflows over the past 6 months. But here's what's interesting. The inflows are coming primarily from institutional investors, not retail. We can see this in the 13F filings. Major hedge funds and asset managers are building positions. These are sophisticated players who have access to the same supply and demand data I'm showing you. They're not buying silver because they think it might go up. They're buying because they've done the math, and they know it has to go up. There's also something happening in the options market that's worth paying attention to. Open interest in out-of-the-money silver call options has exploded. We're seeing massive positions in $40, $50, even $75 strike calls expiring in the next 12 to 18 months. Someone is making very large bets that silver is going to move significantly higher, and they're willing to pay substantial premiums for that exposure. This isn't retail speculation. These are institutional-sized positions. Now let's talk about the geopolitical dimension, because this is where things get really interesting. We're in the early stages of a global monetary reset. I know that sounds dramatic, but look at what's actually happening. The BRICS nations are actively working to reduce dollar dependence. They're settling trade in local currencies. They're building alternative payment systems. They're accumulating gold and silver reserves. Russia just announced they're backing the ruble with gold and commodities. China has been accumulating gold reserves for years and is now doing the same with silver. India is encouraging citizens to buy gold and silver instead of holding rupees. This isn't conspiracy theory stuff. These are official government policies. When major economies start backing their currencies with hard assets, it fundamentally changes the value proposition for those assets. It's not just about industrial use or investment demand anymore. It's about monetary demand. And monetary demand is essentially unlimited because it's driven by the need to maintain confidence in currency systems. Here's a thought experiment. If the United States decided tomorrow that they wanted to back even 10% of the dollar supply with silver, how much silver would they need? The M2 money supply is about $21 trillion. 10% of that is $2.1 trillion. At current prices, that would require about 67 billion ounces of silver. The problem? Total above-ground silver inventory is estimated at around 3 billion ounces, and most of that is tied up in industrial applications, jewelry, and silverware. The amount of silver available in investment form is maybe 2 billion ounces, tops. You see the problem? There's not enough silver in the world to back even a fraction of the currency supply at current prices. The only way to make the math work is for silver prices to go exponentially higher. This is the same dynamic that drove gold from $35 to $850 in the 1970s. The amount of currency in the system vastly exceeded the amount of gold available to back it, so gold had to reprice higher to balance the equation. Let me tell you about what's happening in the physical silver market right now that most people aren't seeing. Delivery times for large silver orders have gone from 2 weeks to 8 weeks. Premiums on 1,000-ounce bars, which are the standard form for industrial and institutional buyers, have gone from 50 cents over spot to $2.50 over spot. That's a 400% increase in premiums. When premiums are rising while the spot price is relatively stable, it means there's a disconnect between the paper market and the physical market. The paper market is saying silver is worth $31. The physical market is saying it's worth $33.50, and you still have to wait 2 months to get it. This disconnect can only persist for so long before it resolves, and when it resolves, it's going to resolve in favor of the physical market, because at the end of the day, you can't make solar panels or EVs with paper silver contracts. You need the actual metal. There's also something happening with silver mining stocks that's worth noting. The major silver miners are trading at valuations that imply silver prices are going to stay flat or decline. The average silver miner is trading at about 8 times earnings. That's historically cheap. For comparison, gold miners are trading at about 15 times earnings. The market is essentially saying that silver mining is a bad business at current prices. But if you believe, as I do, that silver is going significantly higher, then these mining stocks are absurdly undervalued. Here's why this matters. When silver starts moving, the mining stocks are going to leverage that move by 3x to 5x. If silver goes from $31 to $50, which is just a return to the historical gold-silver ratio, the mining stocks could easily double or triple. And if silver goes to $75 or $100, which is entirely possible given the supply dynamics, you're looking at 5x to 10x returns in the mining stocks. But here's the thing about timing. Nobody can predict exactly when this move is going to happen. What we can say with confidence is that the setup is in place. The supply deficit is real and growing. Industrial demand is accelerating. Investment demand is starting to return. The geopolitical backdrop is supportive. The technical setup is bullish. All the pieces are there. What typically triggers these moves is some kind of catalyst that shifts market psychology. In 1979, it was the Soviet invasion of Afghanistan and surging inflation. In 2011, it was the European debt crisis and QE2. This time, it could be a currency crisis, a major industrial user defaulting on supply contracts, a COMEX delivery failure, or simply the market waking up to the supply deficit that's been building for years. The point is, you don't want to wait for the catalyst to be obvious, because by then, the easy money has already been made. When silver was at $6 in 1979, people said it was expensive because it had been at $4 the year before. When it hit $15, people said they'd missed it. When it hit $30, people were kicking themselves. And when it hit $50, everyone wanted in, but the move was basically over. Right now, we're in that early phase where the fundamentals are screaming that something big is coming, but the price action hasn't confirmed it yet. This is when the smart money positions itself, not when CNBC is running stories about silver shortages and your neighbor is asking how to buy silver coins. By then, you're late. Let me give you another historical example that's relevant. In 2000, gold was trading at $280 per ounce. The fundamentals were incredibly bullish. Central banks were printing money, debt was exploding, and gold mining supply was declining. But the price just sat there for years. People who bought gold at $280 were called crazy. Then, in 2001, gold started moving. By 2011, it had gone to $1,900. That's a 6.7x return. But here's the thing. If you waited until the move was obvious, until gold had already gone from $280 to $500, you still made 3.8x. But you missed the first double. Silver is in that $280 gold moment right now. The fundamentals are screaming. The setup is there. But the price hasn't moved yet in a way that makes it obvious to everyone. This is your window. Now, I want to address something that skeptics always bring up. They say, if silver is so great, why isn't it higher already? Why aren't the big institutions piling in? The answer is actually pretty simple. Institutional money is slow. It takes time for large funds to build positions. They can't just wake up one day and buy $1 billion worth of silver. They have to do research, get approval from investment committees, build positions slowly so they don't move the market against themselves. But we're starting to see the early signs that institutional money is coming. The 13F filings show it. The options positioning shows it. The ETF inflows show it. It's happening, just slowly and quietly. Until it's not slow and quiet anymore. There's also the fact that silver has been in a bear market for most of the past decade. From 2011 to 2020, silver went from $49 to $12. That's a brutal decline that scared a lot of people out of the market. But bear markets create the setup for the next bull market. All that selling, all that pessimism, it clears out the weak hands and sets the stage for the next move higher. We're now 4 years into a new bull market in silver. It's gone from $12 to $31. That's a nice move, but it's nothing compared to what's coming if the supply deficit continues to widen and industrial demand keeps accelerating. The 2011 high of $49 is going to be a speed bump, not a ceiling. Let me talk about the investment case for a minute, because I want to be clear about what I'm saying and what I'm not saying. I'm not saying you should put your entire net worth into silver. I'm not saying silver is going to $500 per ounce next month. What I am saying is that silver represents one of the most asymmetric risk-reward opportunities in the market right now. The downside is probably limited to the cost of production, which is around $22. So from $31, you're risking maybe 30% in a worst-case scenario. The upside, if we see anything resembling the supply crisis that the fundamentals suggest is coming, is 100% to 300% or more. That's a 3-to-1 or better risk-reward ratio. You don't find setups like that very often in markets. And here's the other thing about silver. It's real money. It's been money for 5,000 years. If the financial system goes haywire, if currencies collapse, if we see a major crisis, silver is going to hold value. It's insurance as much as it's an investment. You're not just betting on price appreciation, you're protecting yourself against systemic risk. The window for getting positioned in silver at reasonable prices is closing. Not because I say so, but because the math says so. You cannot run a 215 million ounce annual supply deficit indefinitely without prices adjusting to balance supply and demand. It's not possible. Either prices go higher to ration demand and incentivize more supply, or we run out of silver. Those are the only two options. And given that silver is essential for the technology transition that every government in the world is committed to, given that you can't make solar panels or EVs or 5G infrastructure without it, the idea that we're just going to run out is not realistic. Prices have to go higher. The only question is how much higher and how fast. My best guess, based on the supply and demand fundamentals, is that we're going to see silver test $50 within the next 18 months. That's just getting back to the 2011 high. From there, if the supply situation doesn't improve, and I don't see how it can given the lead times for new mine development, we could easily see $75 to $100. And if we get any kind of monetary crisis or currency debasement panic, all bets are off. We could see triple-digit silver. But even if I'm wrong about the timing, even if it takes 3 years instead of 18 months, the direction is clear. Silver is going higher. The only question is whether you position yourself now while it's still in the low 30s, or whether you wait until it's at $50 and wish you'd acted sooner. This is not financial advice. I'm not telling you what to do with your money. I'm showing you the data and the setup and letting you make your own decision. But I will say this. In 20 years of analyzing markets, I've rarely seen a setup this compelling. The fundamentals are undeniable. The supply deficit is real. The industrial demand is accelerating. The investment demand is returning. The geopolitical backdrop is supportive. Everything is lining up. The window is open right now. But windows don't stay open forever. At some point, the market is going to wake up to what's happening. And when it does, the move is going to be fast and violent. You want to be positioned before that happens, not chasing it after the fact. So take a hard look at your portfolio. Think about your exposure to hard assets. Think about what happens to your wealth if currencies continue to debase and inflation stays elevated. Think about whether you're adequately protected against the systemic risks that are building in the financial system. And then make a decision. Because the one thing I can guarantee is this: in 5 years, silver is going to be trading at a very different price than it is today. And you're either going to be glad you acted, or you're going to be wishing you had.